Hi, my name is Craig Basinger, and I'm the Chief Market Strategist at Purpose Investments, and I'm joined also with Greg Taylor, our Chief Investment Officer, just to give a quick macro update and portfolio thoughts in this obviously very interesting times in our publication called A Very Different Year. I'll just pause here for a few seconds on the disclaimer and then jump right into it. So, up until recently, the market had proven to be relatively trendless and actually very resilient. For the last few months, up until, let's say, sort of the last week and a half, we've had a market that has been enduring a lot of bad news on the tariff front, on the policy front, but it had remained relatively resilient. And the reason being is that the economic data was quite strong, and earnings were quite strong, and this sort of helped support the market and absorb a lot of this sort of headline content. However, what's happening more recently is the tariff risk is starting to escalate and starting to take a bigger toll on markets. And obviously that's triggering some of the weakness that we've seen over the last little while. And our analogy is the market has just started to become rather impatient with all this sort of policy noise that's obviously negative for risk assets, because there's one thing the markets don't like, and that's uncertainty. I think one of the other issues that's starting to rise up here and probably doesn't get as much headline attention is the economic data has been softening for a little while now. This is in the US, and this is the US Economic Surprise Index, which measures economic data relative to expectations, and it's actually turned a little bit negative. And that had been sort of supporting markets up until recently, but now it has turned negative, and that's starting to weigh on things. And you add on to that, yeah, inflation has ticked up a little bit, but I think the bigger story on the inflation side is, in 2023, inflation came down a lot. In 2024, it continued to move in the same direction, albeit at a slower pace. But more recently, it's sort of flatlined, which sort of has people starting to worry that maybe this inflation thing isn't quite gone into the rear view. And I think that's made a more challenging market and has made markets more sensitive to a lot of the headline news. Now, I'm going to talk a little bit about tariffs, because how can we not talk about tariffs in this day and age? That's obviously the topic of just about every conversation. And let me tell you, this chart is on the right is trade uncertainty for the U.S., and it is higher than it was during the initial tariff war between China and the U.S. And that's obviously weighing on markets quite a bit. Now, the good news is tariffs, and especially obviously hits pretty close to home here in Canada. Tariffs are obviously terrible for our economy. If we do get these kind of tariffs, it could very easily push Canada into a recession. The good news from the TSX's perspective is it's not overly sensitive to actually cross-border trade as many people think. So it's actually probably worse news for our economy relative to the stock market, but still none of it is good news, don't get me wrong. And I think a lot of this uncertainty is really starting to weigh onto markets, and that's why we've been seeing recent weakness. And just to give you an idea of what's been going on, this is just the last 3 months and plus April. And these are all the different tariff announcements, either being turned on, delayed, paused, reintroduced. And it's not, and this is just Canada, which are obviously the circles are major events, either delayed or tariffs announced. And clearly, I'm just going to call it flip-floppery as far as a policy perspective. And I think that's what's really been weighing on markets. But it's not just Canada. This is steel and aluminum is going through the same situation. The fair and reciprocal research being done in the US is another aspect that's going to have a whole bunch of trade reports hitting the president's desk in the US that'll probably result in more headlines. Autos are in there. And then, of course, there's China and Europe and tariffs on that side, too. So this policy on again, off again is not good for markets. And I think the markets are finally starting to say they've had enough. And this chart really captures it really well, because these are all the big days for tariff announcements or delays. And basically, up until recently, tariff announcement would come on, market would go down. Tariffs would be delayed for 30 days, markets would bounce back up. And it was that sort of reactionary function. But that last one on March 6th, where tariffs were actually delayed for another month here in Canada and in Mexico, and the markets still went down. Delaying them isn't enough for the markets to sort of brush this off. And I think that's why we're seeing a lot of the weakness of late. Now, I'm going to say, there's a whole bunch of policies going on in the US, and some of them are actually kind of positive. So deregulation is a big one for the Trump administration, and this is positive for economic growth. And we've seen some of it so far, and I think that's certainly a positive aspect that's out there. But there are others too. Immigration, which is probably, cutting down on immigration in the US is going to be somewhat negative for growth. But more importantly, it actually could add to inflation because, again, a lot of that's going to tighten the labor market, which is already pretty tight, and put some upward pressure on wages potentially. And then there's DOGE. So that's the Department of Government Efficiency. Listen, I'm kind of torn on this one as an economist. I think it's actually a good idea to go after efficiencies. Clearly, I don't agree with the approach they're taking, but this is actually addressing a very long-term problem as far as deficits. So on the surface, it's a good idea. How it's being implemented, maybe not. Nonetheless, these kind of layoffs that they're going through in the US, this is going to be pretty negative for growth, and is going to start showing up in a lot of the labor data in the coming months. And we think there's a very distinct possibility we get an economic growth scare around the corner, which again wouldn't be too positive for markets. So listen, one of the things that we've been talking about is they are sort of flooding the field with policy announcements, and the markets are clearly reacting not very well to it. One of our beliefs is that if the market does react negatively enough, which we might be getting close to that, we might get a bit of a Trump put, which means that they might back off a lot of these policy announcements, or at least slow down the cadence. And I think that would certainly be a positive turn on markets. But now I'm just going to pass it over to Greg, who's going to talk a little bit about our portfolio thoughts from a positioning perspective.
Yeah, thanks, Craig. And I think with that backdrop and the uncertainty, I just want to talk about just how we're going to allocate strategies and what we think should be investors' weightings in different asset classes, because there's a lot of uncertainty. There's a lot of things out there to be worried about. But at the end of the day, there are still opportunities. And I think you want to make sure you position your portfolio for those opportunities, and also kind of to stay away from areas that there is a lot of risk, because we definitely know that there's going to be some wild headlines coming out. And I think it's also important just to think about what got us here, because we're coming off of two very strong back-to-back years. And this is something that I think was an interesting setup that was going to cause some volatility anyway. And I think that's something that's also adding to some of the uncertainty that we've got in our investors right now. So when you're looking at the asset mix, we are definitely more defensively tilted. We've got more cash. We're a little more overweight. It's nice to have cash as an investable asset with some nice yields in that area. We're also overweight diversifiers. On bonds, we're a little more on the underweight side, and in equities, we're kind of more neutral. Now, within each of those categories, I just want to go into looking at them. So on the equity side, we're definitely a little more neutral weight on this side, more defensively tilted. We're actually starting to see more opportunities in the international side. We'll go in that in a little bit more, but after 10 years of the US market really dominating flow of funds, dominating just investors' psyche on equities, we're starting to see a bounce back in international markets. People have basically written them off for dead, but Japan had a really nice year last year, and Europe's really kicked it off with some strong returns this year. On the Canadian side, we're still a little more underweight. And also on the US side, when we are allocating towards US, we are definitely looking at more of an equal weighted approach versus a market cap weighted approach. We do think there's risk in the overall indices. And that's really to the fact that the Magnificent Seven and some of the big cap tech stocks are too big a portion of the fund. And I think there's a little bit too much evaluation risk at that point of view. On the bond side, we are underweight bonds, but we're seeing some pretty good opportunities in the investment grade bond side, a little more higher on duration. And we're starting to see the ability to take some profits on the prefs. Really nothing against the asset class, but it had such a good run in the last few years. Taking some money out of that and allocating it more towards investment grade bonds is how we're going to position within the fixed income market. And then on the diversifier side, we think with the volatility, you want to have diversifiers in your portfolios. Having something that can take advantage of volatility is going to add some value. And also on the real asset side, we do think gold is a good place to be. The US dollar, we're starting to see pull back a little bit. That's good for gold. And we're starting to see other investors wake up and realize why gold is part of their portfolios. And we think that's going to be something that can add value throughout the year. Now, touching back to 2025, again, it's starting to be a very different year. Don't have to tell you that. I don't think we're going to be setting up when another year of 20% plus gains in the S&P 500. And a lot of that is causing just for the bearish sentiment. What we're showing in this chart is a survey that's done with American investors called the AAII survey, and asks investors just a question: are you bullish or are you bearish? And you can see that that survey is at the bottom of that. So that means there's almost a record number of bears out there right now, which is a little different. This is normally looked at as a contrarian indicator. You normally want to be buying when everyone's selling and selling when everyone's buying. And right now, everyone's very bearish, and that's normally when you start to be buying, which is different because this is the type of reading you normally get when you've got something negative like COVID or the global financial crisis out there. This isn't something you see when you're only a few percentage away from all-time highs. So investors are very bearish. Makes you wonder how much of the bad news is already priced into markets. The other thing to watch again is just the international markets are really crushing it. The TSX is down a little bit, but the S&P 500 is down worse. But really, the emerging markets, Europe, Asia, they're all doing very well. And there's a lot of reasons for this. Some of it's really just on valuation. Again, the S&P 500 and the American markets have done very well for the last 10 years. That's resulted in higher valuations on these international markets. And I think we're starting to see investors that really had shunned away from these markets come back, say there's actually some good stuff going on in Europe, and we're starting to see some allocations towards those markets, and that's starting to really pick up some gains and catch some attention. So we would be overweight the international markets within some multi-asset funds. Now, on the other thing within the US market, again, you want to more tilt towards equal weight versus market cap weighted indices. And this, again, is the Magnificent Seven stocks, which have dominated returns, are getting more expensive. And there's a reason for them getting expensive. The chart on the top right shows that these companies in the Magnificent Seven were dramatically outperforming on growth metrics for the last number of years. But they've now started to see those metrics pull back. So they're actually starting to look and have returns fairly similar to the broader market. That doesn't justify the difference we've seen in the valuations. And I think that's one of the big contractions of what's causing the volatility as we start the year and having more of a stumble in the NASDAQ and other parts of the market more heavily exposed to technology. So concentration in the broader indices is still a risk. And we would be tilted more towards equal weighted versus market cap weighted. And finally, again, looking at diversifiers, gold has been really doing well at the start of the year. We look like we're getting close to hitting that $3,000 an ounce metric. And it's really interesting to see that gold has been going up in this price in US dollar terms, even with the US dollar doing quite well. It has already broken out to record levels in Europe, in euro, yen terms, and also Canadian dollar terms. Now starting to see it break out to these levels in US dollar terms is really interesting. And this is the time we're just starting to see investors start to look towards it and start to buy the gold ETF. The great chart on the right is showing that we haven't really seen a lot of investor interest in buying the gold ETF. That's starting to pick up now, and I think as gold starts to go higher, we'll get more of that. What is interesting is in the last few years, the central bankers globally have been buying gold. I think that's what's got us in this level right now. If the retail investors come back, we could see this moving higher again. So diversifiers are a good part of the portfolio, and again, I think we'll do well in a volatile market, as Craig mentioned earlier.
Thanks, Greg. And yeah, listen, I just wanted to finish it off here with, one of the graphics that we developed early on with this, with the new presidency in the US, which is sort of how we think about things. And, as we said, they're sort of flooding the field as far as policy announcements. And it's, you sort of have two choices in our view from a portfolio construction perspective or portfolio management perspective. You can run around and react to them. Obviously, the challenge with that is, these things get announced, they get pulled back, they get delayed, they get, kibosh. I would highlight Greenland. We haven't heard anything about Greenland in like almost more than a month now. So, this is a very fluid environment, and I think sort of chasing the noise or reacting to it with knee-jerk kind of a mindset could really cause some damage to portfolios. So our approach has been, stay the course, certainly listen to the announcements and see if the market overreacts. And I think that's probably where the opportunities come from. So far, I think we've seen a bit on the Canadian dollar because it certainly is a cheap currency. And maybe if this sell-off gets a little bit worse on the equity side, we could be seeing an opportunity on that side as well. But listen, 2025, it's a very different year than we've had in a long time. We are certainly tilted towards more defense. There is good news out there. I mean, the global economy is actually on a decent footing. We are seeing broadening earnings growth, which again is positive. It's not just these mega caps anymore. It's actually proliferating more and more across the spectrum of companies. Recession risk, even though it is starting to tick up now, is still, I would say, is still relatively low. And financial conditions continue to get easier. There's still more rate cuts coming, and that certainly is a positive backdrop for markets. But countering that, all that sort of good news, Greg is right. Starting points matter. We rolled into this year with everybody excited about economic growth and exceptionalism and everything, and valuations were high. And very often when markets are too optimistic coming into something, just the law of averages, chances are it's going to get a little bit disappointed, which I think what we're going through right now. And this news flow from Trump is certainly starting to wear down the market patience. And yes, having a third strong year, very unlikely. So our view is this year is probably going to be more muted returns, probably flatter, hopefully flat-ish in single digits. But I think there's going to be some pretty big bumps along the way. I think right now we're in one of those downward bumps. Hopefully there's some upward bumps as well. And I think that's going to become a bit more of a dynamic and tactical kind of market as we go through 2025. Certainly a more challenging year. Thanks for listening. And if you have any questions, please feel free to contact either one of us or your salesperson. Cheers and have a good day.